More homeowners are refinancing their mortgages with shorter terms, 15 or 20 years instead of 30, taking advantage of the lowest interest rates in decades.
So is it something that maybe you should think about? Personal finance expert Carmen Wong-Ulrich, who's the author of The Real Cost of Living. Always nice to have you with us.
Good morning, guys.
You know, it seems like we hear a lot, this is actually a good move for you in the long run because then you're not spending quite as much money, giving your bank as much money. But is it really a good move?
Sort of, maybe. Well, let's see. But here's why it's happening. For example, LendingTree just came out with a survey that showed that their requests for 15-year mortgages were up 30% last quarter. And that's really huge. It's a record for 7 years. So this is what's happening. How'd that whiplash of the stock market last week treat you, right? So a lot of Americans are saying, you know what, I don't see any safe havens for my money. Where is my money safe? So physical assets seem safer. They may not be, but they seem safer. You want to touch it and feel it and have it. Also, too, the stock market, like I mentioned, there's a lack of faith in the American stock market and the ability to withstand the swings. Now, we've seen huge swings in the housing market as well, but again, it just feels more stable. And, you know, also, too, think about this, though. This is all counterintuitive if you've talked to accountants. 4.5% on a 30-year loan? This is tremendously cheap money. So it's cheap money. It doesn't mean that you should be paying it off. It's not like it's 18% like in the 80s.
But why shouldn't people be in a rush, though, to pay off their mortgages?
Here's the thing. Simulations have been run over and over the years. You know, everyone from Consumer Reports to financial planners always run this scenario. Historically, nationally, housing market returns about 3 to 5%. Because here's the thing, when you get a mortgage, you're not just paying that interest rate. It's not all about the interest rate. You're also part of a market. You're part of the housing market that moves, for example, in Nevada and Florida, down 60% sometimes. That's probably not going to happen again because it also went up tremendously. But you are looking at not big returns. And the simulations that have been run show that over a 20-year period, diversified investments in the stock market always out-earn the housing market. So that's why it may not make financial sense.
Okay. But if you are thinking about it, what are some of the things you have to ask yourself? Who would be a good candidate for this?
Right. In terms of a good candidate, you want to be somebody who, if you're going to refi, someone who's already put some years into the mortgage. So let's say you've already paid 8 years off on your mortgage. Well, you don't want to refi into another 30-year because, again, you want to think about, I want to own my home eventually. Refinance into a 20-year. You still keep your payments low, but you still are locking in some of those savings at 4.5% or 5%. Also, if you have very little bit of debt, if you have little credit card debt, no credit card debt, hopefully, you've got a lot of cash and you've got a lot of money to invest in for retirement. You're on track for retirement. This can be something that you want to think about. Say, oh, you know what? I'd rather have a 20-year than a 30-year. That's someone, and you don't move. If you're going to move within a couple years, you're not going to enjoy the savings, really. You enjoy more savings the longer you hold on to the mortgage.
Any caveats here, though, to the shorter mortgage?
A couple caveats. Don't forget closing costs. Like in a state such as New York, between the taxes, we're talking almost 10% of the purchase